So let's get started. You must evaluate the purchase of a proposed spectrometer for R&D department. So this is about purchasing an equipment. And equipment purchase usually requires a significant investment, and it produces future benefits. So we can say that this is a capital investment and it requires capital budgeting decisions. Okay. The purchase price of the spectrometer, including modifications, is 260,000. Now, remember that when we purchase an equipment and we do any modifications or maybe like, make some changes in even the transportation costs are added to the cost of the equipment. So maybe like we bought it at 200,000, but like, the modifications and other things added, it came out to be 260,000. That 260,000 in total becomes the cost of the equipment. That is our investment in the equipment. However, if you, for example, when you were deciding to like, which equipment to purchase and like, you were doing some probably a feasibility study whether the equipment would be good for you or not, and you spend some money, like let's say $10,000 on that feasibility study, that cost is what we call a sunk cost, and it is not included in the capital budgeting decisions. So anything spent before the purchase of the equipment is a sunk cost, like feasibility study or market analysis or something like that. But here, they don't talk about any of those problems, so we're good. And the equipment will be fully depreciated at the time of purchase. Now, this is another thing that we need to note. This equipment will be fully depreciated at the time of purchase. What does that mean? It means that this $260,000 will be, at time zero considered as an expense. And when it is considered as an expense, it goes to the balance sheet, the income statement for that particular year. And also, we get a tax benefit because when we consider something, when we have an expense, it is deducted from our revenues, and it reduces our net income, and thereby it reduces our tax burden. So we also get a tax benefit. Now, you know that in other cases where you buy an equipment or a building or something, it is depreciated over the life of the project or the machine. In this case, this is a particular case where you are allowed to depreciate the whole equipment right at time zero. So please make a note of that. Now let's note these numbers down as they come up. So the cost of the equipment, the purchase price is 260,000, including the modification. All right, 260,000, not 26. Okay. The equipment would be sold after 3 years for 30,000. Now, when we sell the equipment for 30,000 after 3 years, that will be considered as our income. And reason for that is because we've already depreciated this equipment, fully depreciated this equipment as time zero. It means that we're not considering any salvage value, but if we get anything at the end of the project, that will be considered as an income. So we will have to pay tax on that 30,000. But let's write it down. We have a salvage value of 30,000. 30,000 salvage value. Okay. The equipment would require a 13,000 increase in net operating working capital. So net operating working capital means current assets minus current liabilities. Okay, so this is 13,000. It will require an additional investment of 13,000. So what could those investments, those working capital could be? Like we buy some, buy supplies or other things, maybe some tools, etc., etc., for this machine. And this 13,000 is an amount that we will be able to recover when the project ends. So right now we are investing 13,000. It will be a cash outflow, a negative number, but at the end of the project, we will get that money back, and that will be a positive cash flow. So the project would have no effect on revenues, so it is not increasing any revenues, but it should save the firm 24,000 per year in before tax labor costs. Now, it is not giving us any additional revenue, but it is saving us money. in our existing operation. So can we consider that 24,000 per year is the income of this project, of this machine? Of course, because we're saving the 24,000 because of this machine. So that is the benefit. So I'm calling this cost saving 24,000, but this is actually the revenue or cash inflow from this equipment. Tax rate for this firm is 25%. So I note that down. And WACC, do we have a WACC? Okay, it's not given yet, but let's see. Now, what are the questions? What is the initial investment outlay? So that is the first question for the spectrometer after bonus depreciation is considered. That is, what is the year zero cash flow? So the initial investment is, we can see we have 260,000 to purchase the equipment, and we also invest 13,000 for the parts and inventory. Uh, However, we get a tax benefit on the 260,000, which means that this is not going to be a 260,000, but we will multiply this with 1 minus t to find the after-tax cost of this equipment. Remember that we are fully depreciating this, so all of this will be considered as an expense in the first year. So there's the first question. Let's go to that. Question one is initial investment outlay. Question two is cash flows for year 1, 2, and 3. So that we'll find those cash flows. And question three is, should we accept this project at 11% WACC or not? Okay, so that is given in question B. WACC is given to us 11%. And the question is, should we accept this project or not? Should we buy this equipment or not? That is question number 3. Now let's go to question number 1. What is question number 1? Initial investment outlay. All right, let's get started. What is the after-tax purchase price? We know that the purchase price is 260,000, but what is the after-tax? Because we are converting this into expense in the year zero. So the after-tax after tax would be equal to 260,000 multiplied by bracket start 1 minus t, right? 1 minus the tax rate, and tax rate is 25%. We close the parenthesis, and that is the after tax. Now I put it in the wrong, should be right here. Okay, let me do that again. Equals to 260,000 multiplied by 1 minus the tax rate, which is 25%. So that comes out to be 195,000. So even though we're paying 260,000 for this equipment, the after-tax cost is 195,000 because the rest will be saved to us in the income taxes. How much is the increase in working capital due to this project? That increase in working capital is given to us 13,000, okay? Now, what will be the total investment outlay in year zero? That will be equal to the after-tax cost of purchase plus any investment in the working capital. So the total investment outlay in year 1 would be $208,000. That is our cash outflow. Okay, and we can make this as negative number. So you can also, like this one, make this negative so that we know that it's a cash outflow, and we also make this negative, so that's a cash outflow. So 208,000 is cash outflow. So we're done with part 1 of this question. Now part 2, is there any question on this? Confusion, anything? All good?
Yes.
All right. Okay, fantastic. If there's any questions, just let me know. Just stop me in the middle, shout, and I will stop and go back and explain it. Okay, so the next question is, what are the cash flows, or in other words, the free cash flows for year 1, 2, and 3? Now, in order to do that, we have to consider the benefit that this project is giving us, this cost saving. So that will be one benefit. Okay. Other benefits would be, we will see whatever we have, but we'll have to consider depreciation and other things. Now, in year 0, there is no cost saving. So I have made this template for you. Savings in year 0, there are no savings because we just started the project, okay? However, in the first year, this project will save us $24,000. So that can be considered as a benefit. And I'm going to press the F4 button because when I drag it to the right, it will stay the same 24,000 because the problem says that it will be saving 24,000 each year for the next 3 years. Then we go and we less the depreciation. Depreciation in the first year has already been considered in this number, right? You know, when we were considering 195,000, we got this number. We already removed the depreciation expense. So in year 0, we don't consider that. And for the remaining years, depreciation is 0 because the equipment has already been fully depreciated in year 0. All right. So that means there is no depreciation. However, if there is depreciation, we will consider it. What will be the EBIT, earnings before interest and taxes? That will be equal to any benefit that we get from the from this project minus the depreciation. But depreciation in this case is 0. I'm just doing this for formality so that you understand. Just in case there is depreciation, you are doing the subtraction in that way. Now, this savings could be a revenue, like, you know, another problem, it will not be savings, it will be a revenue, additional revenue that is generated by this project. Then so, you know, that's the EBIT, then we calculate taxes. Of course, we pay taxes on what we earn. So taxes will be 24,000 multiplied by the tax rate. What is the tax rate? That is 25%. And when I'm on this cell, I'm pressing the F4 button because I want all of these numbers to be multiplied with 25%. I drag it to the right. So each year we're paying 6,000 in taxes. Okay. So what are the after-tax cost savings? Okay. Of course, we are saving 24,000 each year as a result of this project, but on those savings, we are paying 6,000 in taxes. So the net savings each year is going to be 18,000 for the next 3 years. So these are after-tax savings. In other words, this is the EBIT into 1 minus T, if you can recall. What was the formula? EBIT into 1 minus T. So we got the EBIT into 1 minus T for all the 3 years. Now, what we need to do is to find the free cash flows. For the free cash flows, we need the income, this is the net income. So from this project, the net income or EBIT into 1 minus T is 18,000. So I make that equal. Then we add depreciation. We are adding, remember, we subtracted depreciation right here in order to calculate the net income, but then we are adding the depreciation back because depreciation is a non-cash expense. However, in this case, the depreciation is 0, so it doesn't make any difference. However, if there is some depreciation, we will have to add it back. So that's done. Now we are going down to the terminal values. Is there any benefit, any cash inflow that we will be getting at the end of the project? Yes. You see, there was this 30,000 that we'll be able to sell this machine for. Now, when we sell that machine after 3 years, of course, that is an income for us. So we will have to pay taxes on that income. Therefore, we need the after-tax salvage value. So equals to, we take the salvage value, which is 30,000, and we will multiply this with 1 minus T, which is 25%. Okay. That means our after-tax salvage value is 22,500. That means like, I mean, we'll sell the equipment at 30,000, but net benefit will be 22,500 because we'll be paying taxes on this. Okay. Is there anything else that we'll be recovering at the end of the project? Yes, that is the 13,000 that we initially invested in the inventory in the working capital. But at the end of the project, we will sell that inventory and get this money back. However, at the end of the project, at the beginning of the project, it was a negative cash flow. This is something that we invested, but at the end of the project, it will be a positive cash flow. So that will be equal to, let me put another negative to this, and it will be this number, so that it becomes a positive number. Okay. Now, what will be the free cash flows? These are the free cash flows for each year. So what we're going to do, we're going to add all of these numbers to find the free cash flows. Okay, so equals to, what I'm going to do is equals to sum of these numbers. Okay, so for year one, that is 18,000. For year two, the same, but in year three, we have a bigger number. So these are the free cash flows. However, in year zero, we had a negative cash flow, which needs to be considered as well. And how much was that? It was the 208,000, this number, initial investment outlay of $208,000. So these are the final free cash flows. The problem, however, is asking only for the free cash flows for year 1, 2, and 3. So they're not asking you in part B of the question, they're not asking you for the cash flow of year 0. But that is already that was the question number 1. They asked it in question 1, so we already calculated it. However, if you want to consider the full 4 years of cash flows, that would be something like this. Any question? All good? Okay, now let's go to the next question.
I think you got a question in the chat.
Oh, please.
The question in the chat.
Okay, let me check it. Okay, so the after-tax savings is the net income. Yes, you can say that because there is no depreciation, and the after-tax savings, or if this is the after-tax EBIT, earnings before taxes, interest and depreciation, that would be the net income. That's right. Thank you for asking the question. All right, now the last question, question C. If the WACC is 11%, should the spectrometer be purchased? Well, what we need to do in this case, well, we have got the free cash flows of this whole project, and our cost of capital is 11%. So what we need to do in this case, let's find the NPV of this project at 11%. If the NPV comes out to be a positive number, it means that this project is earning us more than 11%. Okay, if the NPV is negative, it is earning us less than 11%. So in that case, in case of a negative NPV, we will not purchase the project, the equipment. In case of a positive NPV, we will purchase the project. So let's do that. Question number 3, we will find the NPV equals to, the NPV formula is NPV. We will select the rate. So the rate, of course, is the WACC that we're going to use, and that is 11%, comma, we select the cash flows. Remember, when we calculate NPV in Excel, we start with the second cash flow. We ignore the first one in this formula. So we close the parentheses, and the first negative cash flow will be added separately to the same formula at the end. So we first select the numbers, except the first one, and then we add it back at the end. So that comes out to be 138,000, and it's within parentheses. That means it's a negative number. NPV is negative, so as the NPV is negative at 11% WACC, the project should be rejected. Makes sense? Okay, so that is it. The second question, I checked it and it's pretty much the same with some additional details and stuff like that, but it's pretty much the same. So I will. Question?
Yeah, so you called the working capital inventory. Is it always inventory, or are there situations where working capital is not inventory?
Okay, that's a very good question. So working capital is actually your current assets minus current liabilities. Okay. In this particular problem, they have given us the working capital directly. Okay, so what do they say in the problem here? They say that the equipment right here, the equipment would require an increase in the net operating working capital of 13,000. So they have given us the number. If they don't give us this increase in the operating working capital, and they have given us current assets and current liabilities, then we will do current assets minus current liabilities. And that is what you actually do in your group project. Okay, so let me go to your group project and show.
Yes.
Yes.
Okay, and this is what I did earlier. Like, there was a question like, what is the working capital? So in the previous problem that we just discussed, they had given us the working capital directly, so we didn't have to do any calculations. In this case, they have not given us the working capital, so we need to find it out. That working capital would be equal to the current assets right here on row number 29, 15,000, minus current liabilities, which is row number 36, minus this one. So we get the working capital, and then you drag it to the right, and that will give you the working capital at any given year. And you can see that the working capital decreases as we go along. So initially we invested 15,000 in working capital, but in the second year that investment went down to 14,325, which means that we recovered some of that money, right? And the change in working capital, we can calculate that as well. So what will be the change in working capital? Of course, in the year 0, we made an investment, so that is 15,000. Okay. And then the next year would be the change would be the next year's, or the current year's working capital minus the previous year's working capital. So that comes out to be minus 675, that which means like there is a decrease of 675 in the working capital. And then you drag it to the right, and you can see like we recover $50 in the second year, and 50 in the third, and so on, and then it stays like that. So that is how we calculate the change in working capital.